I think the markets are fairly, quote unquote, priced to perfection. But I think the next 3 months between now and the end of the year are going to be extremely volatile. We saw a little bit of that volatility at the beginning of August. We saw it a little bit again at the beginning of September. I would expect to see that same type of volatility into October, into the election, and potentially into the end of the year.
Brent Johnson, founder and CEO of Santiago Capital, host of the Milkshakes, Markets, and Madness podcast, and also co-author of the Macro Alchemist Research Service. It is so great to welcome you back on the show. It's been way too long. Great to see you as always, Brent. Thanks for joining me.
Yeah, thank you for having me back. I know we've been trying to do this for a little while, but summer got busy, but here we are.
Certainly. Well, we always love having you on the show. We had you on episode 22 back in the day, episode 79, and now I think we're recording 196, episode 196 today. So
that's great.
A lot has happened since we last had you, and I'd love to start where we always start with our guest, and that is with the big picture, that macro view, where we are today. And as you know, Brent, you can take all the time you need to set the table when it comes to that macro picture.
Yeah, well, I think... Gosh, it's really hard to say where we're at because I feel like we've been in this same spot for at least 6 months, if not a year, and that is awaiting the Fed rate cut, right? And there's been so much talk about it, and there's been so much written about it, and there's been so many market moves based on it. To me, it feels like we're almost at it's no longer news. Now it's probably a sell the news event as opposed to, news when it actually happens. I do feel like the Fed has, for the most part, and I got to be careful how I say this because I already know I'm going to get crucified for saying it, but I feel like the Fed has done a pretty good job if you think central banks should exist in the first place. The reason I say that is because I know there's a lot of people out there who they're never happy with what the Fed does. They're never happy with monetary policy, and they don't think central banks should even exist in the first place. But if you do think that central banks exist, and you do think that they should try to be involved and smooth out, the markets here and there, post the huge inflationary pressures after COVID, when they have started to try to get inflation under control, they have done a pretty good job of doing that. They raised rates much more than anybody thought possible, and they were able to do it without causing a complete collapse of the economy. There's many people out there who said the Fed would never be able to raise rates even once. And if they did, they would cause a severe recession. But not only did they raise rates once, they raised them many times. They took it from 0 to 5.5%. And now and since that time, inflation has dropped tremendously. Now, it doesn't mean that it's perfectly under control, and it doesn't mean there isn't any more inflation, but it's certainly not where it was a year and a half or 2 years ago. And so now they're trying to engineer this quote unquote soft landing. I personally think that they are going to have trouble continuing to do it, but so far they have done it. Now, again, it doesn't mean that it will end well. I'm just saying at this point in time, they've done a pretty good job. I do think that there are several things out, and I think the markets have rewarded them by, the markets to me are for the most part priced to perfection. With the exception of gold, everything is priced to perfection. And what I mean by that is gold is saying, hey, wait a minute, things aren't as rosy as the labor market would say. They're not as rosy as the high price stock market would say. They're not as rosy as the low VIX would say. The gold is saying, hey guys, hold on, there's something wrong here, right? But other than that, everything is pretty well where the Fed would probably want them to be. And as such, I think the markets are fairly, quote unquote, priced to perfection. But I think the next 3 months between now and the end of the year are going to be extremely volatile. We saw a little bit of that volatility at the beginning of August. We saw it a little bit again at the beginning of September. I would expect to see that same type of volatility into October, into the election, and potentially into the end of the year.
Mm-hmm. I would love to just flesh that out a bit more. You're talking about, the Fed engineering this soft landing, but they're going to have trouble continuing to do that. And I imagine that also has to do with the volatility that you see in store. Can you just elaborate a little bit more on that point of them having trouble continuing to engineer the soft landing?
Well, I think for the most part, I think the market or market participants, they've been anticipating these Fed cuts, and they've been anticipating several Fed cuts. And as a result, the markets have held up because they think once those cuts arrive, anything that's bad in the market or any pressures that exist in the market will be eased. And they will not only cut this once or twice times, they will continue on a rate cutting path. And as a result, discounted cash flows will rise, the ability to service debt will become easier, and as such, equities should go higher. But I think that's to miss history a little bit. Typically, you will see that after the first cut, equities have historically, or when equities have sold off, it has often been after the first cut. And the reason for this is because the reason that the Fed would be cutting is the economy is slowing, right? Now remember, the reason they raised rates in the first place is they wanted to slow the economy. That's the whole point of rate hikes, was to slow things down and get inflation under control. But what they want to do is they want to slow things down, but they don't want to cause a crisis, right? And that's why I say they've been able to kind of engineer the soft landing so far. But I think because everything is priced the way it is, if they cut now with unemployment near its all-time lows, stock markets near its all-time highs, earnings pretty strong, wages not falling, they risk having the inflation reaccelerate. That's number one. Number two is, if things are so great, why are they cutting, right? So I don't know if they're just trying to, engineer this soft landing, or the no landing as some people call it, or if they see something under the hood that nobody else sees, or that the market in general doesn't see, and they're trying to get ahead of that. Now, typically, the Fed is a reactionary agency. They typically wait for the problem to develop and then try to react to it. It's possible that this time they are trying to front run something that they see. I don't know that that's the case, but that is possible. But this is where I think it gets tricky for them now, is because some people are expecting them to cut 25, or just about everybody is expecting a cut. It's just a question now of whether they will cut 25 basis points or 50 basis points. If they only cut 25, then the market will probably be disappointed, because a lot of it is expecting 50 basis points. But if they cut 50 basis points, then they have to explain, why are you cutting 50 basis points when everything is priced to perfection? What do you see that you're not telling us? So I think Powell has a real challenge this week of managing expectations. If I had to guess how things will play out, I think this week will be very volatile. I think whether they cut 25 basis points or 50 basis points, I think he will do his best to be dovish and try not to cause any chaos. Perhaps we get a couple days of a bounce, or into next week, some kind of a follow through. But I would personally be surprised if we just continued to go higher and higher and higher into the election. I think that we will see some volatility, and I think we will see some downside in equity markets. I think a lot of that has to do with it being a sell the news event, because it's already all priced in.
Mm-hmm. Did you see Senator Elizabeth Warren calling for 75 basis points? Do you see that headline this morning?
She's been doing that for a while now.
Yeah.
And, when I hear politicians talking about finance, it just kind of drives me crazy, because most of the time they don't know what they're talking about. But, on the one hand, she'll say we need to get inflation under control. And on the other hand, she'll say we need to cut, 75 basis points. And in many ways, those two are kind of opposite to each other.
Yeah. Brent, you were talking about markets, and one of the areas that's not priced to perfection, or saying, hey, wait a second, things don't look so rosy, that is gold. I've actually had a lot of folks recently ask for another guest on gold, or just to kind of explain what's been happening as it relates to gold. You seem like the perfect guest here. What's going on with gold, and what do you think it is signaling?
Well, I think several things are going on. Number one, I think part of it is that gold, to me, and I think in general, gold is kind of a put option against the status quo, right? Or against political idiocy, or against central bank interference. there is a rising awareness throughout the whole world, especially over the last, call it 10 to 15 years since the global financial crisis and monetary policy has become more extreme, that central banks, governments around the world, not just the US, are somewhat backed into a corner because of all the debts have gotten so big. And it's really hard for them to continue to manage the economies as they see it because of all the debt. And so the typical playbook is to try to inflate the debt away. The way you do that is you hold interest rates low, and you get real rates negative, and over time, the inflation above the borrowing rate, and over time the debt gets eaten away. Now, so as an example, if you can have 3 to 4% inflation over a 10-year period, annual inflation over a 10-year period, that eats away 30 to 40% of the debt. The problem is, and so I think if the Fed could get inflation at 3 to 4%, and they say they want 2%, but I think that really means they want 3 to 4%. And the reason I say that is they can live with 3 to 4% inflation. 3 to 4% inflation is really annoying and frustrating for the average person, but it doesn't totally blow them up, right? And it doesn't necessarily bring out the pitchforks. But when you get double-digit inflation and people are really, really struggling, that's when the pitchforks come out. And so that is not politically acceptable. But if you can get it to where there's a little bit of inflation, but that it's not extreme, and you can do that for 5, 10, 15 years, you can kind of eat away the debt. One of the things you can't inflate away is gold. There's a limited supply of it. It's in it's in big demand. It's been used as money throughout history. And so many times when you get into an inflationary environment, or even just a chaotic environment where fiat currency starts to come under attack, gold is one of the go-to places to do that. And so I think that's partly what is going on. What I think is what has been going on over the last year, for the most part, is the dollar has been coming down as people expect interest rates to come down, right? And so I think they're largely trying to get in front of that in case there is another massive rate cutting cycle or even a QE cycle. But the interesting thing is that most of the demand is coming from not the United States. It's coming from outside the United States, and primarily it's coming from Asia. And I don't think this is a dollar story. This is a fiat currency of their local fiat currency story. The people in China buying gold, they're not buying it because Jay Powell is going to jack up the printer again. They're buying it because the yuan that they use every day is a horrible currency, and it's losing even more value. And they've got more problems domestically than we have. Their economy is teetering on a deflation, massive deflation. And so perhaps the Chinese are buying gold because they need an alternative to their own currency. Same thing for many of the other countries, whether they're in the Europe or Middle East or South America. You look at the dollar has come down quite a bit over the last 2 years, but you have to remember it's coming down from a 30-year high. It's still about the same level that it was kind of just pre-COVID. And so, if you look at the trade-weighted dollar since the 1980s, it's near its all-time high. That means every other currency is falling versus the dollar. If you look at the DXY index, like I said, it's about where it was just before COVID. So over the last year, the pound and the euro have rallied, but those economies are in more trouble than the United States as well. And the ECB has just started cutting rates already. And so this idea that the Fed is going to be the only one cutting and everybody else is going to have, strong or hard or tough monetary policy, and those currencies are going to really strengthen versus the dollar, and against hard assets, I don't think is the right way to look at it. But I think gold is kind of front running an expected global monetary policy easing cycle, if that's the right way to say it.
This episode is brought to you by Public.com. Public.com has just launched its new bond account offering a 6.9% yield on your investment until 2028, when the first bond matures. Here's why it's interesting. Bond yields are currently at their highest levels since 2009. The Federal Reserve is meeting in September with potential rate cuts being discussed, and current estimates from the CME FedWatch suggest rates may fall as low as 3% by the end of 2025. The good news, investing in a diverse portfolio of corporate and high yield bonds could lock in today's historically high yields, even if the Fed cuts rates. Go to public.com to learn how to lock in this yield. The bond account, only at public.com/Julia. And would you say, are we seeing like more, I don't know the particulars, are we seeing more individuals buy? I know the central banks had been buying gold, but are we seeing individuals also buying it?
Well, I think in Asia you are, but not so much in the U.S. The gold miners index has done very well. The GLD and the SLV have done pretty well, but they've been losing assets. I think, over the last couple of weeks, I'm not sure. They may have gained assets over the last couple of weeks, but year to date, I'm pretty sure the assets are down. So again, it's being primarily driven by those outside the United States as far as inside the United States.
Yeah, it's really interesting to bring that up. Like, it's a fiat currency story. It makes me wonder, Brent, does this also tie into the dollar milkshake theory?
Yeah, absolutely. I mean, again, it's what's kind of funny, and perhaps you've noticed this, perhaps you haven't, but a lot of times when people will try to quote unquote debunk my thesis, they will use gold as an example to prove that it's wrong. And to be absolutely clear, and for anybody who has not heard of this, it's basically my point has been that in some kind of a crisis, in some kind of a, flight to safety, the US dollar will outperform all other fiat currencies for many, many reasons. But that doesn't necessarily mean it will outperform gold. And what I said the very first time I ever spoke about this was that in the years ahead, the dollar would rise versus its fiat competitors. Gold would rise as well. US equities would rise as well. And interest rates would rise. And that's essentially what's happened. So I don't think this is just a dollar story. It's to me, it's an over there's a growing awareness that governments around the world are in trouble. And I think that, Bitcoin is an example of this as well. People are looking for alternative ways to place their assets. Now, that doesn't necessarily mean that they will be successful in escaping the fiat system, but people are looking for it. And so I think, I think a lot of it has to do with they are trying to protect against their own currencies. They're not, the person in Turkey is more worried about what Erdogan is going to do than he is worried about what Jay Powell is going to do. And the same for all these other countries. Their currencies, however bad you think the dollar is, those local currencies are even worse.
Speaking of the dollar milkshake theory, we last had you on episode 79. Obviously, we've got a lot more viewers to this channel. I know a lot of folks are going to be familiar with the dollar milkshake theory, which is a framework you developed to explain how a sovereign debt and currency crisis might play out. You have a great analogy for it from the movie There Will Be Blood. I know you're probably so annoyed being asked the question, but would you mind, just for the folks who aren't up to speed or aware, could you just frame it up and explain the theory to them and the framework?
Sure. So the theory is that if the world gets in some kind of a crisis or in some kind of a slow growth story or in some kind of a, downturn economically, the whole world has the same technology of a printing press. So, when you see these, money printer go brr memes, it's not just the Fed that does it. The whole world does it. ECB does it. China does it. Japan does it. Australia does it. And so the whole world will print or generate this liquidity mix, right? They will shoot this liquidity out into the global economy. But for many reasons, some of them deserve and some of them not deserve, the fact that the United States is the global hegemon and has the global reserve currency, they have a number of advantages that the rest of the world just does not have. And as a result, the U.S. is the one that has the straw. So all this liquidity gets mixed, but the U.S. has the straw, and the U.S. sucks up that liquidity into the U.S. markets. When they do that leads to U.S. markets outperforming the rest of the world. And if you think about it, liquidity is the lifeblood of an economy. You always want liquidity. The lack of liquidity is bad. So if the U.S. gets the liquidity, that means it's coming from somewhere. And if it's leaving someplace else, the place that it's leaving is now going to suffer or is going to struggle more than the place that has the liquidity. And so the point has been is it becomes kind of a self-reinforcing cycle. Dollar strength begets more dollar strength. Because as the dollar gets stronger, the rest of the world goes into crisis. As they go into crisis, people seek out a safe haven. As they seek out a safe haven, the dollar and gold is the two places they go. That causes even more. And so you can see how this becomes a vicious cycle. Now, some people have said to me, well, the dollar has fallen over the last couple of years. Doesn't that prove the theory wrong? Well, I suppose you could say it proves the theory wrong in that we haven't had the crisis yet. And I'm the first to say I thought we would have already had a sovereign debt crisis, and we have not. But the point I'd like to make is that you can have periods of dollar weakness. If the U.S. is running a weaker monetary policy than its peers for a short period of time, or if the U.S. is starts QE before the rest of the world, you could have a period of a couple months or a couple years where the dollar falls versus its competitors. But if that happens, then those other economies, as their currencies rise, they will start to struggle with deflationary pressures, and they will eventually have to do QE as well. And so all dollar weakness does is kick the can down the road. And remember, if we have plenty of dollars in the system and dollar liquidity is plentiful, that is not a crisis. A crisis develops when there is no dollar liquidity. A crisis develops when you can't access funding. But if there's plenty of dollars in the world, and as a result, the DXY or the trade-weighted dollar or the however you want to define, or the dollar versus its foreign competitors is falling, that is the central banks remaining in control and the system, the status quo, continuing to function. What causes problems is when the US dollar rallies quickly versus its foreign competitors. And in part of the reason, and I know I'm going on for a long time here, but part of the reason,
mind. I love it.
Part of the reason is because something that is called the euro dollar market. Now, most people have never heard of the euro dollar market, and those that have don't know what it is. And it's not. And here's the thing: is as Americans, we don't really have to know what it is because we grew up with the dollar as our home domestic currency. And so most people in America, if you ask them what the dollar-euro exchange rate or the Brazilian real US, they wouldn't even know what you were talking about. But if you flew to Rio and you asked them what the dollar exchange, you found a random person on the street with the dollar exchange rate, they would know what it was. Same in Australia, same in China, same in Japan. And the reason is because the whole world uses dollars for funding, for trade, and for invoicing, for a number of different things. And as a result, the dollar exchange rate with their local currencies is extremely important to them as savers, as investors, as business owners, as traders. And so as the dollar rises versus other currencies, it puts incredible amount of pressure on those countries because now their funding just got more expensive. And I should step back a little bit. The whole world borrows in dollars. It's not just the United States. So a lot of people know that the United States owes like $36 trillion in the national debt now. The heck of a lot of money. Not going to sit here and say that's not an issue. What most people don't know is that the rest of the world owes about the same amount to each other in dollars. So they don't owe it to the United States. They owe it to each other in dollars. And so as U.S. interest rates rise or as dollar supply becomes constrained, it becomes harder for them to service that debt. It becomes harder for them to take on new debt. It makes it harder to pay off the principal when it comes due. And this is the main difference between the U.S. dollar and all its other competitors. It's a demand, and my point is it's a demand story. What the U.S. has that the rest of the world doesn't is foreign demand for its local currency. People in Japan don't need Brazilian and reals, right? People in Turkey don't need Japanese yen. People in Norway don't need Turkish lira. But the whole world needs dollars. And so if the whole world is printing, that provides a supply, but one country has more than demand for all the others, in a crisis, that currency will rise, and that's the US dollar.
Okay, let me ask you this as a follow-on. And again, you can take all the time you need to explain because our viewers love it.
Okay.
So Sounds like everything is relative, but this scenario puts a ton of pressure on other countries who are borrowing in US dollars. My very basic question is, well, what if, I imagine, and I'm not an expert here, there could be some like geopolitical consequences or tensions from this. It sounds like there could be.
Oh, absolutely.
Yeah,
Absolutely.
I would love to explore like more of the implication side of this. Yeah.
Well, so your listeners have probably heard a lot about de-dollarization and the desire for de-dollarization. Part of the reason that there is a desire for de-dollarization is that countries that want to de-dollarize, in many ways, don't have control over their own money supply, and they don't have control over their own funding, and they are somewhat, and in many cases, very exposed to the whims of the United States. And they don't like that. Most governments want to be in control. That's the whole point of the government in the first place, is to control things. But when they have to use a foreign currency that they can't print, that they can't access on their own, that they need to be kind of under the good graces of the United States to get, that causes problems. So the fact that this euro-dollar market exists, they don't really like it. They would prefer to have a currency that they can control. But because the euro-dollar market has gotten so big and so entrenched, it's very hard to get out from underneath it. And as a result, the United States can use the dollar as, quote unquote, the ultimate weapon. In my opinion, the dollar is the biggest weapon the United States has. Now, whether they choose to use it as a shield, whether they choose to swing it as a sword, I think that changes from time to time. But the U.S. can absolutely use the dollar as a weapon. And the thing that makes it so powerful is they can do it under the guise of what's good for the United States. In other words, I'll just use 2022 as a perfect example. The U.S. was experiencing high levels of inflation, politically unacceptable levels of inflation. Now, again, I said at the very beginning, the Fed, the central bank, the government would love to have 2 to 3 to 4% inflation, but they don't want 8, 9, 10% inflation. And because it was at 8, 9, 10%, it was politically unacceptable, and so they had to do something about it. And so they raised rates. They raised interest rates to slow the economy and to crush inflation. That's one of the reasons they did it, and that's the public reason they gave for doing it. And while they will never say so, they absolutely understand that in doing that, it puts enormous pressure on the rest of the world. And as the hegemon, as the global leader, as the king of the mountain, however you want to define that, you can always negotiate better when you're in a position of strength than when you're in a position of weakness. And if your economy is doing okay, but your competitors are really struggling, it's much easier to enter into negotiations with those competitors when you're doing it from a position of strength. And when you look back at 2022, when the dollar was really strong, economies around the world were in crisis. The Chinese real estate market bubble popped and has fallen tremendously since then. That's due to deflationary pressure. That's partly due to a strong dollar. The ECB had to, institute a program to buy Italian bonds and some periphery bonds because those yields were spiking. The Bank of England had to bail out their sovereign market, and the Bank of Japan had to bail out their sovereign market and their currency. This all happened in August and September of 2022, which coincided with a 30-year high in the dollar. That is not mere coincidence. Now, you can say that wasn't the primary reason the U.S. raised rates, but it certainly didn't hurt the United States that happened as a result of raising rates. So the point I would make with de-dollarization, yes, there is a huge desire for de-dollarization. It's much easier to say that you want to do it than to actually do it. If it was easy to actually do it, it would have already been done years ago. But the fact that it hasn't been done is proof of how difficult it is to do. The other thing I would say is that that there is nothing the rest of the world can do to send the dollar lower if the U.S. does not want it to go lower. So the fact that the dollar has been falling over the last couple of years, that's because the Fed is getting what they want. That is not the result of some other country doing something. And that in other words, if the U.S. wanted to take the dollar index back to 105 or 110, it would be very easy to do so. All they have to do is say, maybe they cut once on Wednesday and then they say, you know what, we're done. We're not cutting for the next year. The dollar index would rally like crazy. And people will say, well, that would send the market down. Okay. Market went down in 22 and they kept doing it, right? The point is the U.S. controls the dollar, the price of U.S. dollars, and that's the U.S. interest rate. If it wasn't for this euro dollar market outside that everybody owes each other and uses the dollar for commerce, for trade, for investments, the U.S. would not have this power. But the fact that the rest of the world is addicted to the dollar, for lack of a better way of saying it, gives the U.S. this power. And countries hate it, and many people hate it. But it is what it is. That is the actual reality.
You pointed out earlier that this isn't just a dollar story. Like in this scenario, you have the dollar, equities, gold, and interest rates would all rise. I remember watching the video you did with Real Vision. When was that? That would have been
It was the summer of 2018.
Okay, so 6 years ago.
That was the first one. You might have seen a different one, but that was the first one.
Yes, and I think you even opened this is a story that doesn't end well. Something along those lines.
That's right.
Explain that. Yeah. Okay, so some people might say, okay, great. Equities rise, they might think maybe there's some benefit, but it's not a story that ends well. Can you just explain that side of things?
Yes.
Also, how might someone feel this event? Would it be just so noticeable? How might it impact a typical individual?
Well, it kind of, yes. Okay. So I did say that. And the reason I said, and I still hold to that, the whole dollar milkshake theory, it's a framework for what I think will happen in a crisis, but it also basically just explains how the monetary system works. I don't necessarily want it to be this way. This is, when I first came up with this, part of the reason that I thought I was on the right track is I hated the answer. And I tried to disprove it myself many times, and I couldn't do it, and nobody's been able to convince me that I'm wrong with it so far. I would love for somebody to convince me I'm wrong, but they haven't been able to do it yet. But the reason I said this is a story that ends badly is a lot of gold rising is not necessarily a positive event for the world and for humanity. That's a sign that some things are seriously wrong, right? The dollar rising dramatically is the sign of the system not stopping functioning correctly. In other words, the system was not designed for the dollar to get dramatically stronger than the rest of the world. If you think about it, the dollar underlies the entire global economy. If the dollar is rising, that would mean that most things are falling, right? If most things are falling, that's not a good situation. And so this idea that the dollar going lower will lead to de-dollarization, no. That's things continuing to function as they have been. That's the perpetuation of the status quo. It's only the dollar going higher that causes a lot of chaos. And again, just go back to 2022 and look and see what happened. Not only that, but you can go and look at a chart for the last 25 or 30 years, chart the DXY or the trade-weighted dollar, and overlay financial crisis on top of it. You get 100% correlation. And the reason is because in a crisis, liquidity disappears and the underlying collateral rises in value, and that's dollars. And so the dollar going higher, that's not a good thing. And that's why I said it will end very badly. And part of the reason that I think equities, U.S. equities, will go higher is because I think sovereign bonds, even U.S. Treasury bonds, will very possibly fall in value. And as yields go higher, that draws even more people into the dollar. So in other words, a sovereign debt crisis, because that's what's kind of sparked all this, was what would happen in a sovereign debt crisis. A sovereign debt crisis is when the world decides they are no longer going to fund governments. Now, that's not just when they decide to no longer fund the United States. It's when they no longer fund Italy and France and Australia and Japan and China. So when sovereign bonds get rejected, where does that capital flow to? I think the most likely place for capital to flow, if they start rejecting sovereign bonds, is gold and U.S. equities. And so that's why I said you will get into a situation where interest rates will rise, the dollar will rise, U.S. equities will rise, and gold will rise. And so what's interesting to me is that we haven't had the crisis yet, but all of those things have happened. And so maybe the sovereign debt crisis will never come. Maybe the central banks and the governments and the monetary authorities can continue to kick the can down the road. We won't have any kind of fiscal crisis or sovereign crisis or market crisis. And the dollar index will bounce around between, 90 and 110, and we'll have periods of, growth, and we'll have periods of slowdown. And 20 or 30 years will go by and nothing will have changed with regard to the monetary system or a sovereign debt crisis. But if we do get into a sovereign debt crisis, and I stand by my thesis that is how it will play out. It'll be really interesting to see if we ever get into one, if I'm right or not. But I always tell people I'll be happy if I'm wrong, because if I'm right, that's not a good thing. And if we never get into one to find out whether I'm right or wrong, that's fine too. Because, people don't realize, like 95% of my business, I own traditional assets. I own stocks, I own bonds, I own commodities, we own gold. My clients own real estate. We don't want all of this stuff to go bad. I've got a pretty good life, I'm happy with the way things are. If they continued like this, that would be just fine. But part of my job is not just trying to figure out how to make money, but how to protect it and be ready for these rogue waves that come out of nowhere. And part of doing that is understanding how the system works. And so, so far, this framework has allowed me to remain invested in traditional assets, but be prepared for volatility and not lose sleep and kind of be able to kind of carry on with living my life rather than people. There's a lot of people who check out and move to a mountaintop and their plan is to come back in 10 years when the smoke is cleared. And, I'm just not going to do that. I actually kind of like this, right?
Yes.
This is my job. It's fun. But it doesn't mean that it's not scary, and it doesn't mean that you don't have to prepare. And so I feel very lucky for having this framework, because it's allowed me to navigate pretty crazy markets for the last 5 or 10 years.
Exactly. It's a framework.
Exactly.
And also, it's not a certainty. No one knows anything for certain. And sometimes a lot of folks out there, they'll just be so certain.
If for people that listen, once you realize that nobody knows anything for certain, everything gets a lot easier. And once you say I can be wrong, it makes everything so much easier. So again,
totally.
I don't know for sure what's going to happen, and it's possible I'll be wrong. So far, I haven't been, but we'll see.
Totally. Okay, let me turn back to just markets. Markets have been reaching all-time highs of late. I was listening to you earlier in your answer toward the beginning of the conversation, talking about maybe some downside, but also markets being kind of priced to perfection. Would love to just get more of your take on the state of markets right now. Are they in a bubble? What do you make of the valuations? Are we in a bubble? Let's just explore markets. Yeah.
So I think, yes, we're in a bubble. I think the bubble will get smaller, but then I think the bubble will get much, much bigger. So in other words, I'm expecting, at least in the U.S., over the last several years, the U.S. has outperformed the rest of the world. I expect that to continue. There's I've said this many times. I may have said this on your show before, but I'll repeat it because I think it's a good way to think about things. There's kind of 4 things that can happen as far as the global economy. One is that we don't have a crisis and everybody grows together and everything's fine. In that case, being invested in the United States works just fine for me, or being invested primarily in the United States works just fine for me. We could have a situation where the whole world goes down together, some kind of a crisis, and all assets fall all over the world, in which case I'm no worse off being primarily invested in the United States versus the rest of the world. A third thing that could happen is that the rest of the world could do really well and the U.S. could do really poorly. I think that's a very, very, very low probability event, but I can't completely rule it out. but it is possible. And the last thing that could happen is that the rest of the world could do poorly, but the United States could do okay. So 3 out of those 4 things, I'm better off being in the United States primarily than invested around the rest of the world. And then the 4th possibility, I think it's such a low probability event that I can't rule it out, so I have to be prepared for it, but I don't need to put my whole portfolio into it. And that is kind of why I have, erred towards, placing most of the assets that we have invested in U.S. markets. Now, getting back to the bubble, I think I have a hard time seeing U.S. assets doing really poorly while the rest of the world does well. Most of our investments are still in the U.S., even though I think it's possible that in the short term, and I think it's even probable that we have some downside. Just because we've had so much upside, markets don't tend to go in a straight line. There's no straight lines in nature, right? Things go up, things go down, there's cycles. I think we've had a very strong move up. I think we need to go down. I think going down does a couple things. It changes positioning a little bit. It brings some uncertainty into the market. It scares some people onto the sidelines. It scares some people into short positions. And then that money on the sidelines or the short positions or the people that are scared, that can provide the fuel for then people to go in and buy the dip and push things back higher. Not only that, but I think for the Fed to really go on an easing cycle, I think, they're probably going to cut this week. It's almost a certainty. But beyond that, it's not that clear what they're going to do. In order for them to really cut interest rates in a dramatic way, I think there needs to be a lot more downside. They need cover to do it. And at this point, I don't think that they have cover to do it. And I think that they're underneath the surface. I don't think the economy is as strong as a lot of the economic indicators would say they are. And then the third thing, or maybe it's the 4th thing, I can't remember what number. A lot of the problems that I think that could develop are not necessarily due to a problem in the United States. In other words, downside could come because of a problem in China. Downside could come because of the war going on in the Middle East. Downside could become because of the yen carry trade. There's a number. I'm much more worried about the external U.S. market causing a crisis than I am about the U.S. market causing a crisis. I have to be ready for all of it. So this is a long way of saying I expect between now and the end of the year a lot of volatility, probably downside of the markets. But over the next 2, 3, 4 years, I think U.S. equity markets will go much higher. I think gold will go much higher. I think the dollar will go much higher, but it won't necessarily be for good reasons.
So wait, just to make sure. So the bubble gets smaller because of the downside, and then it balloons back out. Just help me understand okay.
That's kind of my base case.
Okay.
Yeah.
How about so gold? I'm looking at the gold price right now. We're just a little bit north of 2,600 right now.
Yep.
Okay. I don't know if you're one of these folks who has a price in mind for gold or where it could be headed, but what do you think of the current price level? And I guess you see further upside.
Well, I got to be careful. I already know how this is going to go. I can read the comments in my head as they come in.
Oh no. Okay. Yeah.
And so listen, I first started buying gold for clients in 2006 or 7. I have owned gold forever. I think gold is the most important asset in a person's portfolio. I think every client should have it. I think it's the cornerstone of every portfolio. And if you don't own any gold, you should probably go buy some today, even though it's at an all-time high. If you already have your gold allocation, I would not be buying more at these prices. Sentiment is as high as it's been. Positioning is getting very stretched as far as speculators. I don't like buying anything at an all-time high. And if we have volatility, part of the reason that gold is as high as it is there's plenty of liquidity right now. Part of the reason that stocks are as high as they are right now is that there's plenty of liquidity right now. I would expect between now and the end of the year, we're going to have a period of time where liquidity disappears or at least falls from current levels. When that happens, that's typically bad for risk assets. If you get into some kind of a liquidity event, gold often falls just as fast and sometimes more than other risk assets. The difference is that gold typically recovers faster and stronger than anything else. And so my point is, if you already own gold, you've done very well. You don't need to buy more of it at these prices. If it goes much higher, great. You've already got your position. You're making money. But if it pulls back, 5 or 10%, that would be an opportunity to then potentially buy more or trade it. But and kind of the same thing with silver. It's so funny that people get so sensitive about these positions. Is silver is one of these things that for years, 10 or 15 years, silver has been expected to go to $50, $100. You talk to some people, it's going to go to $500. In the years ahead, I expect silver to go much, much higher. But in the short term, I expect it to go lower. I think both gold and silver will be lower a month or two from now. Now, if they're not, that's fine. And I'm not this is not me saying that everybody should go out and sell their gold. And just because I think things are going to move in price doesn't mean I'm either going to go buy them or sell them. I think there's parts of your portfolio that you should just buy and own and just forget about it. And here's the thing with gold is once you've bought your gold position, there's not much else to do. There's no earnings that you have to follow to see whether earnings are growing or falling. There's no management team. There's no costs associated with it other than your storage fees. So to me, part of the reason I don't spend the time just hammering and talking about gold all the time is it's once you buy it, you're kind of done, right? And so I want to be clear. I think everybody should own gold. I think everybody should understand that in the years ahead, it is kind of the canary in the coal mine of whether things are going good or bad for the world economy. But it's not. I'm not somebody who thinks you should have your whole portfolio in gold and that's all you should own, and just be sitting with 95% of your portfolio in gold and 5% of your portfolio in some kind of liquid cash position. I think if you have a 10 or 20% position in gold, which for many people that would be high, but to me that's the right amount of gold to have in a portfolio.
Yeah. It's kind of hard to believe, like, we're going to be wrapping up this quarter and only have another quarter left of 2024. Yeah. You were talking about like volatility. It does make me just think of the upcoming election, just from an investor perspective. Like, how important is the election from that lens? How are you thinking about it?
So this is a little bit of a nuanced answer. In the big picture, I don't think it really matters. And what I mean by that is I kind of feel like we're in this fourth time period. The dice have been rolled and we just got to let it all play out. I've said many times, I feel like we're in this Game of Thrones. And I say that jokingly, but I'm also kind of serious. Like, it's a big it's not just a domestically politically uncertain time, it's a geopolitically uncertain time. All countries are facing economic struggles due to the amount of debt in the world. And so I feel like that is a situation that just kind of has to play out. There's not much that can be done to stop that, I don't think. Now, on a little bit shorter time frame, I think who is president does make a difference, especially on a geopolitical standpoint, because I think Trump's geopolitical positioning or outlook or system of operating would be much different than Harris's. From an economic standpoint, I think it would only matter to a degree of extremes, and what I mean by that is the economic policies that Biden has done are not that much different than what Trump had done before. Trump mentioned this in his debate, and it's actually true. If they thought that Trump's economic policies were so horrible, why haven't they changed them? And they really haven't. They left a lot of Trump's economic policies in place. And it's because they we're kind of in this place where countries are kind of withdrawing and they're trying to take care of themselves first, right? That's Trump's America first, but even around the world, you see the same thing. And so, and that's a political reality that I don't think that the other side, meaning the Democrats, can ignore. And I think they're even, of that mindset, maybe not to the same extent as Trump, but I think they're kind of the similar mindset. So while from that perspective, other than the extreme, I don't think it really matters that much between Trump and Harris who gets into office. You got to remember, if Trump gets into office, it's going to be much more chaotic and volatile just because he's not part of the quote unquote machine, right? Harris is very much a product of the machine. And so she's very much a product of the status quo. So if you get somebody in there who is not part of the status quo, is very clearly not part of the status quo, the opportunity for volatility is just heightened just as a result of that person being in there.
I didn't ask you this, but we only have a few minutes left, and you put out a report on the Macro Alchemist about the yen carry trade and a bit of a history of these carry trades over the years. And it was funny because like when that happened, that unwind, you were someone like that I thought of because I was like, gosh, I wonder what Brent thinks. I'd love to get his perspective on this. I know it's been some time since it's happened, but maybe more of a retrospective looking back at it. What do you make of it? And is this kind of is it a bit of a sign of things to come?
So I'm really glad you asked about this because I think this gives me an opportunity to explain some really important points. And I would encourage anybody who's kind of interested in this topic, go to the website is macroalchemist.com. You just put your information in there, and then you have access to all the reports that we have written so far. And the yen carry trade is the most recent. But we didn't just write on the yen carry trade. We wrote on carry trades in general. Part of the reason we did this is because as a result of the chaos we had 6 weeks ago, and the yen carry trade was often mentioned as part of the cause, there's been a lot of people talking about these carry trades and what they are and how they work. And it seems to me that most people that we're talking about them don't really know what they're talking about. Now, that's not to say everybody, but just in general, we thought it was important for people who are interested in this to have a proper understanding of what it is. So the report doesn't just go on the yen trade, it talks about what a carry trade actually is. And so what a carry trade actually is when you borrow cheaply in one place, and then you go invest those proceeds somewhere else that's paying a higher rate. Very simple example. We'll use the yen carry trade as an example. And there's many ways to do the yen carry trade, but this would be one very simple way. And that is that you borrow in Japanese yen because interest rates are at zero and the yen has been weakening. So it costs you nothing to borrow it. The currency falls in value. Whatever you're investing in goes up in value. You can do something as simple as borrowing in yen and go buy T-bills. So you're borrowing at something that costs nothing, and you're buying T-bills that pay you 4 or 5%. It's a pretty easy trade, right? It's very seductive. And then you can lever it up a couple times, and all of a sudden you're making 10 or 15%, right? And so and you can do the same thing with stocks. You can do the same things with commodities. Another great carry trade would be to short the yen and buy gold, right? Because the commodity is going up in value as the fiat currency loses value. That would have been a fantastic trade. That's a carry trade. The reason that the yen carry trade got so big and has gotten so quote unquote famous is because they have had interest rates at zero or close to zero for decades, right? They have been running these, extraordinary monetary policies since the 90s because they've been dealing with deflation and low growth for a long time. And so that's what allowed the yen carry trade to grow so big. But why I think this is so important is because for a couple of reasons. Is as a result of all the inflation we've had over the last couple of years and the awareness that fiat currency loses value, there's been this groundswell that all you have to do is go buy hard assets because fiat currency is going to get inflated away and the commodities are going to rise in value as they print more money, and it's just easy street, right? That's kind of a carry trade. Borrow in something that's losing value or cheap, and you invest it in something that's going to go up in value. And they'll say that that's even more of an easy thing to do because all fiat is losing value. It doesn't really matter if the dollar rises versus the euro. It doesn't really matter if the yen rises versus the Australian dollar because all fiat loses value. And so you don't even be exposed to fiat. The problem with that thinking is that everything is priced in fiat. And even though over long periods of time, fiat does lose value, it's the change in relative levels of fiat currencies that cause crises. If you go back to like every major crisis over the last 25, 30 years, almost all of them, not all of them, but almost all of them have some characteristic of a carry trade wrapped up in there, or were either exacerbated or caused by a carry trade blowing up. And that is why, and in those periods of time, gold went down with everything else. So a lot of people said, well, just buy gold because fiat doesn't matter. Well, when those crises hit, gold went down as well. And even if as an investor, you have all your money in gold or silver or Bitcoin or whatever this hard asset allocation that you have is, even if you have all your personal investment in there, a lot of people that are listening, I assume, work for a company that does business, that is involved in commerce. A lot of people have their own company that they started. Maybe they work for a multinational firm. Maybe they're managing portfolios that don't have just gold in them. And for those people, fiat versus fiat matters tremendously. If you're running a business, fiat versus fiat is one of the most important things in the world. And again, when fiat currencies, relative to each other, move a lot in a very short period of time, it causes crisis. And we kind of walk through the report kind of step by step of why that is and how things can go wrong. And the reason things continue to go wrong is because one of the things you learn from history is people don't learn from history. They repeat the same mistakes over and over and over. And part of the reason is the allure of these carry trades is so much, and the allure of making quick money easily is something that humanity just falls for again and again and again. And so when you see one of these opportunities arise and you see your friends making money on it and you see your competitors making money on it, it's very hard for you not to engage in it. And then when you finally engage in it, it just makes it get bigger and bigger and bigger. But then something eventually comes along where it goes wrong or the trade goes the other way. And then you have all those people have to sell, right? And when they sell, that exacerbates the downside. And that's what causes a crisis. And so I think the carry trade report that we just put out, I think it does a very, I'm biased, obviously. I helped write it. But I think it does a good job of explaining why fiat versus fiat is important, why carry trades are important, why good stories and good narratives don't necessarily lead to good outcomes, or at least when you see a very popular narrative, you should at least understand what could go wrong with it. Doesn't mean you have to short it. Doesn't mean you have to bet against it. And even if you're involved in it, that's okay, but understand the risks, because a lot of times when you initially invest in these popular narratives, they tell you all about the great stuff. They don't tell you all about the risks. And here's the kicker. Here's the kicker. The whole world, the whole system is essentially one big carry trade. And what I mean by that is because the US is the global reserve currency, and because there's this thing called the capital asset pricing model. And in the capital asset pricing model, the assumption is you can borrow at a risk-free rate, and then you put some kind of an equity premium on it, and then you discount those cash flows. The risk-free rate is the 10-year US Treasury. So by definition, the risk-free rate should have the lowest yield. Now, that's not always the case, but if you look back over the last 25 or 30 years at 10-year rates around the world, in general, the US Treasury is the lowest yielding rate. And that's what makes it the risk-free rate. And that is why everybody, not only because of the euro dollar market, but it's also because of the rate, while the whole world borrowed in dollars, right? So we have all of this investment around the world that's funded by dollar debt. That's why when the dollar goes up in value, the whole world suffers, because it's the carry trade unwinding. So the dollar milkshake theory is essentially explaining what happens when the biggest carry trade in history, which is on the US dollar, unwinds. Does that make sense?
That makes so much sense. And I love that metaphor. And I feel like that's such a great place to leave it. 'Cause, oh my gosh, one big carry trade. I didn't realize just reading the piece, like how many just examples there have been throughout like financial history. I still haven't finished the piece, but I told you earlier, I started reading it before we came on here. Just like the number of these.
This is the thing, is that this is not an unusual, and not only that, the yen carry trade has blown up several times. It's not like it's been out there for 20 years and nothing bad ever happened. It blew up in 2000, it blew up in 2008, it blew up in 2020, and now it blew up again.
Yeah,
and it keeps happening.
Like human nature too.
Yeah.
Yeah, it's interesting. One big carry trade. Really, Brent, it is always awesome having you on. I want to give you like the final few minutes. If I don't know if you have to run, but if you do have a final few minutes, just leave the folks with some parting thoughts. Obviously, let them know where they can find your work at Macro Alchemist. You have an amazing podcast as well, and a great presence on Twitter or X these days. So I'd love to just give you the final few minutes here.
Sure. Well, I'm pretty, involved with social media. I do. We have a show called Milkshakes, Markets, and Madness. The Twitter handle for that. So if you go to YouTube and you type in Milkshakes, Markets, and Madness, you'll find the channel. That's a weekly show that we do. The Twitter handle is @MilkshakesPod. And you can find us there. On Twitter, I'm pretty active. My handle is @SantiagoAU You can also just find it by typing in Santiago Capital. It's the one with the white seashell. And then the third place, as you mentioned, is Macro Alchemist. It's a research service that I started with a friend of mine just recently in the last couple of months. And if you go to macroalchemist.com, you can find it there. And on Twitter, it's macro_alchemist. But I think the final thing that I would leave people with is that it's my perception that over the last couple of years, because we've been in a high inflationary environment, people have said that owning cash is the worst thing you can do because your cash is losing money every day. That's a good understanding to have. And for the most part of your portfolio, I would agree with that. But it doesn't mean you shouldn't have any cash in your portfolio. I think having a 20 to 30% allocation and just in cash or T-bills right now is a smart move. And even if you lose against inflation over the next 2 or 3 months, the reason it's worth it to have that is if we get into some kind of an adverse scenario, some kind of a downturn, now you already have liquidity. You're not seeking liquidity. You're somebody who can be a distressed buyer rather than being a distressed seller. And if you're patient and you wait and you wait for that great opportunity and you put that money to work at a good price, and then that whatever you bought does well, you will more than make up for whatever amount of money you lost versus inflation in the time period that you were sitting on the sideline. So if somebody tells you can't have any cash in your portfolio, don't listen to them. Run the other way. Mm-hmm. I'll just leave it at that.
Brent Johnson, founder and CEO of Santiago Capital. Thank you so much for being so generous with your time, all of your knowledge, your wisdom, your ideas. You are always, always welcome on this show. We love having you on. We love listening to you and learning from you. Really appreciate you taking the time, Brent.
Thanks for having me.